Welcome to India's #1 budget headquarters. Decoding key policies, delivering market-shaping insights, and unlocking the potential of India's growth blueprint. Beaming live from the CNBC-TV18 Motilal Oswal Budget Headquarters.
Taiwanese index is trading lower by 0.6%. The Hang Seng is down 1%.
The India opportunity is a 10, 20, 30-year opportunity.
This is the era for India and over the next 20, 25 years.
Support zone, 25,450 to 25,640, 25,690 or so on the Nifty, which is down about 1/3%. That's 80 points.
The P's, even if you look at a crude measure like that, are not at extreme ends. Many times they are below even the average for the last 1 or 2 decades.
Traditional services, there will be a deflationary impact, and we've accounted for that.
Markets are deep in the red, trading with cuts of about 160 points on the Nifty and 490 points on the sensex.
Because of the rapid changes in AI, will there be some sort of a decision paralysis? Mid-caps, they are sulking, but the headline index is actually reacting more than the broader markets.
Okay, well, that is the day so far, and I mean, it's not a great screen to report on. We're down about 0.75%. We're coming to you from the CNBC-TV18 Motilal Oswal studios, and I mean, we're starting closing bell a little early. I'll just tell you why, because we've got a management waiting by 25,600 or so. So this is a 180-odd point knock. You know, Tuesday, of course, was a great day. Yesterday, we managed a green close. That's about it. And today, I mean, that strength is not lasting, and that is not exactly a great thing to see. Advanced decline is pretty poor as well. There are 2 down for every 1 stock, which is higher. This is, I mean, across the NSE universe. Well, let's bring in the PVR management, which is waiting by. Ajay Bijli is Managing Director at PVR, and Gaurav Sharma is Chief Financial Officer at the company. Gentlemen, great to have both of you here. Thank you very much. And if I can call these results, you know, Dhurandhar-style results, Mr. Bijli, and absolutely, you know, stunning performance by the movie, and I think you were a reflection of what it has done. I mean, just tell us how impactful this has been for you.
It's incredible, and you know, that's what I like about the Indian market and our business. That you know, there's so many movies that come. It's like the Indian cricket team in the IPL and T20. You know, there's so many players packed. That you don't know who's going to perform and win the match, and that's what is happening with the content flow, where you know, you anticipate that this movie will do that much. Even if it doesn't perform, it gets compensated by another film that basically succeeds, you know, exceeds all expectations. So I think that's what happened last quarter. Diwali was subdued. We had some big movies which didn't click, but suddenly came Dhurandhar, and you know, we've had the highest sort of footfalls in the last quarter, and first 9-month performance as well has been the best post-pandemic. And the other good thing is that it's not just Dhurandhar. Even movies which were like brand new stars like Sanyara and you know, Mahavatar, Narsimha, so many films that came. There was no blockbuster written underneath them, and yet they performed very well, which only goes to show that consumers they want to come and watch the movies. If the content connects with them, then of course there is no end to where the performance of the movie can go.
Mr. Bijli, Dhurandhar, is it possible to say what percentage of the numbers are on account of Dhurandhar? Just to get a sense. I mean, it's just a yeah.
Well, it came on the 5th
of December.
December. Yeah. So the quarter, it still did only 24 days of business. So I don't know exactly what percentage it is. Gaurav, you know what percentage would Dhurandhar be of the overall box office of the 3rd quarter? Is that what your question is?
Yes.
Yeah.
So for PVR INOX, Dhurandhar would be nearly in the range of 28 to 29% of our total box office collections for the quarter.
Okay, so that is in line then with the quarter. I mean, basically, it's about a third, right? In that sense,
slightly less than a third.
Slightly less than a third, because then it's kind of evenly split. My other question is, this is to you, Mr. Bijli. It's already on Netflix, I noticed, about 5 days back. It's been about 5 days that it's on OTT, the movie.
8 weeks after the release.
Yeah, so I think 30th or something, 30th of Jan or something, it's on. So is that like a rule, or I was just wondering because it was still going strong, I think, at that point. Could you have, in that sense, juiced it more through in screens and cinema halls before it hit OTT, or that's all pre-decided?
No, it is decided, but it was tapering off.
Okay.
Towards the 7th week, which is a lot for a Indian film, which has been carpet bombed in so many screens. Let's not forget, it was not just playing at PVR Inox, it was playing in so many screens. So I think eight weeks window is after which it has come on Netflix, and that's pretty much the standard and the norm now, which is fine. I don't think it cannibalizes our business. In fact, it makes everybody, all the stakeholders coincide and coexist.
And not to forget, Prashant, Dhurandhar 2 releases on 19th of March. So Q4 is going to have a 12-day bump up on account of Dhurandhar 2. So should we expect another blockbuster, Mr. Bijli? And also separately, finish that off and then tell us about the ad revenues, because that declined by 21%. Despite the higher footfalls, was it on account of the GST changes? What happened exactly? And what can we expect in terms of ad revenues going forward?
Yeah, firstly, I just want to talk about the positive things. Definitely, Dhurandhar coming in the fourth quarter. The second part is a brilliant boost to our fourth quarter revenues are going to be. And also Toxic is coming, which is another very big movie. So typically last year, in fact, in February, we had Chhaava. So this new trend that we're seeing, that even in quarter four, people are releasing big movies. Border 2 also got released on the 26th of January. And that was also a great film and good performance there. So that's the first part of your question. The second is, yes, ad revenue has been disappointing. Not on the 9-month period. 9-month period was still even Stevens as compared to last year, 9 months. But this particular quarter, because Diwali was a bit subdued. Now, Diwali is a very, very important time for ad revenues. Typically, very big movies get released. Last year, we had Singham and we had Bhool Bhulaiya. Both were blockbusters. But this year, we only had one movie called Thama, and which didn't perform at the box office. So that had a big impact on our ad revenues. And also Dhurandhar in the first 2-3 days wasn't perceived to be as big as what Pushpa 2 was last year. Pushpa 2, on the back of the success of Pushpa 1, already a lot of anticipation was there that it's going to be a big movie. So therefore you had advertisers lining up to advertise on the big screen. But in this case, what happened that first few days of Dhurandhar, people didn't know that it will become such a big sleeper hit. So the ad sales got impacted. So I think these are the two reasons why ad sales on quarter 3 in particular have been less, but we'll make up for it in quarter 4.
So Q4 ad revenues have been strong. You said you'll make up for it.
Yes.
What kind of growth are we looking at?
Well, I think year end probably will be close to how we did last year. Is that okay, Gaurav? Fair comment to make?
Yeah, I think we will be slightly better than what we did in full year financial year 25.
Yeah.
Okay, so FY26 ad revenue growth should be higher than FY25 by mid-single digits. I mean, what numbers are we looking at?
So I think we are not looking at any specific numbers around that, but what we can definitely say is that we will finish the year higher than what we did last financial year in terms of the overall ad revenues.
Okay. Now, Mr. Bijli, the divestment of 4700 BC, right? So talk to us a little bit about the thinking there, because FMCG in a way earlier kind of was sort of cited as a bit of a growth pillar. So is this like a pivot away from all non-cinema consumer brands? Because you still have things, I mean, in-house brands like Dogfather, etc.
Yeah, those are just, small, within the cinema. Although we may take them out a little bit, but that's more a QSR type strategy rather than an FMCG. I think 4700 BC had a good run with PVR. Still 50 cinemas of ours continue to sell the brand within the circuit. Only 1%, less than 1% of our revenues in the F&B space. 1800 crores roughly is our revenue. This was only 13-14 crores of revenue inside the cinemas was represented by this gourmet popcorn. But I think after taking the brand to about 100 crores, I think the real journey of the brand was with an FMCG company. And we found Marico to be the perfect fit. And it did become a non-core business for us. So we thought that let's monetize it, sell the subsidiary, and whatever cash we do get in, and we do proper capital allocation for it towards our core business of cinemas, and also look at debt reduction from this cash inflow. So I think it had 10 years or whatever journey that they did, this brand did with us was more than enough. And now with Marico as a specialist, I think this brand will do well on its own.
Yeah, no, I mean, I think did a phenomenal job with that one. Gaurav, on that, what Mr. Bijli said about the debt reduction, so this infusion has come through, and are you on track to be net debt free by the end of this year, this financial year? And once you do it, once that happens, what's the plan? Will you, would you stay on track to getting to that 2,000 stream number? Or in terms of capital allocation, will you return cash to shareholders via dividends? I mean, any thoughts?
Look, we are already, when we finished December 25, we are already at about 350 crores of net debt, which is substantially lower than what it was when PVR Inox merger took place. And I think this cash proceeds which have come in will further accelerate the journey towards a negligible net debt level by the time we finish the financial year. We will use this capital and cash proceeds to pay down some debt. We'll also use it to fund the growth, because we feel that there are pockets in the country where the multiplex penetration is low and we would like to grow in those markets. And, at an appropriate point in time, the board will take a call on in terms of, distribution of cash to the shareholders. But I think in the near term, we want to pare down our debt, reduce it to negligible levels and reinvest this capital in growth.
Just one final question. The Competition Commission of India has also initiated an investigation into the levy of virtual print fee. Can you tell us what exactly is this and how much does it roughly contribute to your revenues?
So virtual print fee contributes less than 1% of our total revenues. And, Competition Commission of India in the month of August had asked its DG to conduct an inquiry in terms of, how this piece is levied. And, because this matter is sub judice, so we would not like to make any further comments on this. But, the discussions with CCI are ongoing and, the process is underway right now.
Got that. Mr. Bijli, looking forward to 26, calendar 26 with the lineup? There is Dhurandhar too, but I mean, I guess there'll be more. As you said, I mean, I think you've mentioned this phenomenon of sleeper hits, I mean, right? And word of mouth is a big one. And it really picks up momentum sometimes.
Yeah, I mean, all stakeholders are back on the table. I'm very excited. I mean, the biggest stakeholder is a customer. He's given his verdict that he wants to go out and watch movies on the big screen. Film fraternity still believes in the theatrical business. It continues to pay more than any other platform, and it becomes a harbinger for the journey of the movie. So, they are very determined to make movies. All these movies, post-COVID, pre-COVID, not even 2 movies had done more than 500 crores. And post-COVID, there's so many films that have done more than 500 crores. And this fact is not lost on the film fraternity. So they do realize that once you release the movie theatrically, there is no cap to how much the movie can earn. So with the results, some very big movies are coming in 26. Shah Rukh's King is coming. The biggest movie ever produced, Ramayan, is coming in Diwali, which is going to be fantastic. And we've also got Love and War. A lot of Hollywood films are coming. Again, Hollywood has been fantastic last year. Lots of movies crossed the 100 crore mark. Big regional films are coming. Rajinikanth's film is coming. So I think if you look at the lineup, obviously it leaves us with a lot of optimism. So that's an incredibly important stakeholder, which is the film fraternity consumer. Even the shopping center developers, real estate, every single mall which is coming up, big town, small town, have again continued to allocate enough space for multiplexes, which means the relevance of multiplexes is there as well. So as I said, still remains and will continue to remain. So these are the indicators to tell you that, there's reason to be optimistic in the coming years.
All right. We'll leave it there, Mr. Bijli, and look forward to good movies in PVR. Thank you very much, Gaurav. Appreciate your time here, as always. Thank you. Good luck.
Thanks, guys.
Okay, 160 lower on the Nifty, 25,610, and it's not a good look so far. Market breadth 2:1 on the declining side. Take a quick break. We're back with Pankaj Tibrewal, founder and CIO at Ikigai Asset Managers. Pankaj has done some numbers, put together some numbers in terms of what the third quarter is looking like, and numbers looking good, especially on the smaller end of the company curve. Coming up in just a bit.
Welcome back. Still down close to about 0.5% on the benchmark indices. The Nifty is below 25,650. Mid-cap index in the red. The advanced decline ratio is in favor of the losing strike. One stock advancing for two in the red. IT has been fairly volatile, but as we speak, the Nifty IT index is holding up with a minor green. Metal index continues to be the biggest drag. How should you position yourself? 1 hour to go before we wrap up the trading session. Mitesh is now joining in. Mitesh, in the morning you were telling us that 25,500. If we get closer to that, it would be an attractive buying opportunity. What have you done today in terms of trades? What's the advice?
I think that view remains. We're still above about 100 points, and the day's lows around 25,560. So I think I would still, want to buy if we get close to about 25,500, take a 70, 80 point kind of a stop loss, and then, hope that we'll possibly retest 25,820 or even 25,900. So I think that's the kind of view I have. Positive, but, given the fact that we're still absorbing the gap which happened 2 days back, I think it might be 1 or 2 days more of volatility. And in that volatility, as I said, I think buying on declines would be a better idea.
Yeah. What about individual stocks, Mitesh? What do you have?
Yeah. On the individual stock side, I have a buy on Wari Energy, and that's Premier Energy, and that's a stock which I would recommend buying with a stop just below levels of 750 for targets of around 815 to about 820, and HDFC AMC. That's really done well after a correction. It's trying to regain its uptrend. So buy here with a stop below 27.15 and a target of 28.40 is what I.
Okay, all right. Mitesh, thanks very much for that. There are some numbers at the bottom of the screen. Minda Corp numbers, I think, are flashing as we speak. But, the other space is the QSR space, which has been in focus. Westlife, I think Devyani Sapphire, there is Jubilant Food, and there is perhaps a little bit of green coming through. JP Morgan, Macquarie, etc. coming through with a view as well. Mangalam is here with a quick snapshot view in terms of what we saw. Mangalam, take it away.
Well, 3 quick service restaurant stocks in particular are doing well today, and the cat among those pigeons was let out by the Devyani international results yesterday, and more importantly, the management commentary, where they said that there was positive same-store sales growth across most of their brands in January, barring Pizza Hut, and for that as well, the process of turnaround has begun. More than that, they've also achieved EBITDA break-even for one of their brands, Biryani by the Kilo, ahead of what they had guided. And then there was a management change too. We have the CFO of the company, Manish Dawar, who will now become the president and CEO of the company from April 1. So all these factors, along with the trigger, which is the merger with Sapphire, doing extremely well. And that explains why Devyani and Sapphire are doing a lot better in today's trading session. In fact, brokerages have written as well. We have Macquarie, which has an overweight rating, a target price of 160 rupees. They're saying that sustaining Jan's pickup is extremely crucial, and that's something we have to track. They announced the merger with Sapphire, and in the near term, there could be some amount of uncertainty. That's what Jefferies believes, but this is a long-term positive. They've upgraded the stock to a buy. And Bernstein weighs in on the new leadership change, where they're saying that this begins a long road to recovery for the franchise. Westlife, the operators of McDonald's, on the other hand, they too have seen positive same-store sales growth in the month of January. And there is a note coming in from Macquarie there too. EBITDA beat was on account of lower royalty payout, and at the same time, normalization of third-party aggregate delivery actually improved their performance in the fourth quarter, along with value offerings in dine-in that did well for them. So positive same-store sales in January needs to sustain for the QSR sector to actually do well from here on. The question again, is the tide turning or is it just a false start that we've seen multiple times in the past? Stock-specific action, obviously the consolidation with Devyani and Sapphire, along with a new change of ownership at Restaurant Brands Asia, will be a key positive trigger to track.
Thank you very much for that. Pankaj Tibrewal, founder and CIO at Ikigai Asset Managers, is now joining in. Pankaj, great to have you today with us. 10 days to go before we wrap up the earnings season. Before we begin and talk about the way forward, how has the earnings season been? What is your expectation? What stood out for you, the trends that you noticed?
Good afternoon. I think we are halfway through the earnings season, and till 2 days back, about 263 companies out of the top 500 companies have reported their results. The heartening fact is that after a long time, we are seeing a double-digit top-line growth. So the top-line growth is about 12%, and the bottom-line growth, adjusted for the labor codes and a few one-offs, is again about 12.5%. So that's a very heartening number. And if we break down these 263 companies into two parts, one is BFSI, which is about 73 companies. The PAT growth is about 9.5%. And if you look at the non-BFSI, which is the bulk of the top 500 companies, which is another 190 companies which have reported, the PAT growth is 14.5%. So I think for the last 2 quarters, even in the September quarter, we saw a very healthy improvement on the non-BFSI space, which continues as we speak halfway through in the non-BFSI space for December quarter as well.
The Pankaj, afternoon and good to see you. The small cap space is where the earnings growth has been much faster. Can you confirm that for us? The smaller companies.
So if you look at this 263 companies in terms of market cap, Prashant, so large caps, about 59 companies have reported. Their PAT growth is about 8.7%. When you look at the mid-cap space, about 87 companies have reported. Their PAT growth is 17.8%. And when you look at the small cap space, 117 companies have reported and their PAT growth is 39.9% as we speak. So obviously there are some stocks on the oil and gas, metal and mining, cement, which has lifted the growth. But the heartening fact is that this is 5th quarter in a row where mid-caps are delivering very high double-digit growth. And small cap, this is the 2nd quarter in a row where the earnings growth is moving towards 25 to 35%. So I think after a long time, things have started to pick up. And Prashant, few things I would like to share with all of you is that our team and myself have been on the ground for the last 20-25 days. And across sectors, we are getting very positive feedback that most of the companies are saying we don't know what has happened post mid of December, but demand has clearly shown a very sharp rise. And this is across, I'm talking about auto ancillaries, it's talking about auto OEMs, cement, steel guys, ancillary to steel, which is the steel tubes companies. I'm talking about consumption. You saw just before this, all the QSR guys talking about good January. So I think ground reality is showing something else. And I go back to 2024, if you remember, Prashant, that valuations were very sky high, but the ground reality was very bad. Now it's just the opposite. Market till 2 days back was not believing that anything can happen in India. But I can only tell you that last 1.5 to 2 months, the ground reality across sectors has started to show very strong momentum. And that's our feedback across different sectors, different companies. And we believe that March quarter, if it sustained in February and March, would be a big surprise for the markets going forward.
And I want to ask you, in this kind of an environment, what should one do? And good to get that feedback from the ground. Obviously, you've met lots of companies who are giving you this feedback, right? So just coming to you, let me just go across to bring in Yash as well and that PB FinTech story. We put out that story first, that they're going to do a fundraise and perhaps looking at acquisitions northwards of 3,000 crores is what we put out, the number, all confirmed. The board meeting notice was put up, etc. Now, and then, of course, I mean, the stock went into a bit of a tailspin, fell about 10%, 12%. And Yash is with us. There was a notice saying that the board meet has been cancelled, essentially. But Yash has got more. Yash, take it away.
Well, a complete seesaw, right? When, of course, we reported, and the same evening, company informed the exchanges that they're looking at a fundraise. According to our sources, the fundraise was quite large in size to support a strong acquisition, a large acquisition. The stock from that point in the next 3 days corrected about 15%. And just with this announcement today of that board meeting for deciding the quantum of fundraise being cancelled, the stocks covered almost about 9-10% in trade today. What we've been given to understand, of course, the company over the last 3 days got a lot of investor feedback, shareholder feedback, which was largely not in favor of this large fundraise and the large acquisition which the company was planning to make. After which the company has put the decision of making that large fundraise and the acquisition in abeyance. What we've been given to understand is that PB Fintech may undertake a wider deliberation before proceeding at all on this particular move of the fundraise or the acquisition. We've written to PB Fintech as well on this particular query. A response from the company is still awaited, but that's the limited point which the company has informed the exchanges, that the board meeting which was scheduled for today to approve that fundraise has been postponed.
All right, Yash, thanks very much for that. So that's PB up about 8-9% in a market which isn't looking all that great. Now, Pankaj, so this is so what you're telling us basically is that there is a disconnect, right? Because you've done your channel checks, the reported numbers are looking stronger, 39% for small caps. Could be, a few resource companies skewing that numbers on the upside, but still overall it's looking up. But market still not despondent anymore. Maybe, same time last week they were despondent. A little better, but there is still a large disconnect in that sense where prices are and where and what the feedback and the numbers that you are seeing. And so how do you make use of that disconnect, Pankaj? What should one do?
I think, Prashant, the market always, like a pendulum, swings from one end to another. Our job as money managers is to identify inefficiency in the market and take that as an opportunity. I believe that after a long time, the broader market space has started to look attractive. There are many companies, good quality companies, which are now available across the board at free cash flow yield of 4 to 5%. And they have not done anything over the last 3-4 years. And growth is starting to resume back in those names. So we believe that it will be a bottom-up stock pickers market, but the breadth of the market, which has been so bad for the last 15-16 months, starts to improve as earnings growth starts to come in. And across the board, we believe that there are opportunities now emerging. When I look at a large number of companies, there are opportunities where I believe in 3.5-4 years, the earnings can double. And that's what we as a team were discussing last night, that which are the opportunities which the markets are completely disconnected with. And I think that's where we have to go in and put in our money to work. And I can only tell you that valuations after a long time, not across the board, but many pockets have started to emerge quite attractive. So from here till the next 3-4 months, we are advising most of our clients to increase their equity allocation. And the volatility which you have seen in the precious metal also, warrants that everything can't go just up. There has to be drawdowns also along the way. And the drawdowns are much, much sharper than equities. So till a week back, if you used to speak to Panwala also, he was saying ki sona chandi khareed lo sir aur baki sab bech do. So I think that has now tried to kind of change with this kind of a drawdown. And my belief is that FIs will also come back. You will be surprised to know, Prashant, Microsoft over a 2-year period has given you almost zero returns now. So one of the Magnificent Seven has started to, flatten out on returns. And our sense is it's early days, but AI bubble, which we have been talking about for almost 5-6 months, has started to show some signs of weakness across the region. Look at a company like Alibaba, 5 quarters of massive downgrades. And now when I look at the valuations of Alibaba, for example, 80% is coming from SOTP, which is AI. So I think finally markets will find its way and saying that AI, there is a reality and there is a narrative. And sooner or later, I think that bubble will pick up. And FIs will return back to India. This year is my view, if earnings growth starts to pick up. And next year, we are thinking about 12 to 14% earnings growth for the broader market for the whole year.
12 to 13% earnings growth for FY27. FIs will come back and seeing some signs of weakness in the AI momentum. What does that mean for Indian IT? Pankaj, we've seen the Indian IT stocks get pummeled yesterday. There are fears that at least it's not that the business model goes out of fashion completely, but there will be perhaps accelerated revenue deflation. How have you all understood the impact on Indian IT?
So if you look at our portfolio positioning, and this is not from yesterday, but last 12 to 15 months, we have been underweight IT. So initially we got hit when IT did well, 2024, if you remember. But last year, I think IT showed a lot of weakness and it was one of the worst performing sectors. We believe that large caps, most of the large 4-5 names will have a tough time in terms of growth. And at max, these companies will be between 5 to 7% growth companies. But when you look at some of the mid-cap companies which are doing extremely well, I think they have embedded AI quite nicely in their workforce. I was looking at one of the mid-cap companies which has been the leader in the last 10 years in terms of market cap creation. And over the last 2-3 years, their revenues have grown up by 40%, but their headcounts have only grown up by 10%. That means higher productivity and using technology as a tool. So I believe that we have to be very stock selective. I don't completely agree to the fact that it's a doomsday. Finally, to implement every software, AI, everything, you need people. But maybe the magnitude of people may come down. And at a certain point, the space will start looking again attractive from a valuation perspective, because don't forget, they throw a lot of cash over a period of time. So we will be selective, and as you move ahead over the next 12 months, I think there will be opportunities to cover our underweight. And maybe at some point of time, if opportunity presents itself, we might go overweight also. So I think we have to be very, very selective in this space. There is no one single answer. And I firmly believe that many stocks will start looking attractive on a cash flow basis.
Got that. Maybe you just want to leave us with one stock to chew upon, to think about. Pankaj, anything?
Nothing. I mean, just...
Not in IT, generally, overall, whatever. I mean, something looking...
See, one thing, Prashant, our framework is that look at companies where the margin is below the average over the last 5-7 years. And if growth starts to come back and balance sheet and cash flows are not compromised and business model is not compromised, I think that warrants a look. Two sectors which are clearly emerging there is one is the consumer durable sector. I think if the summer goes well, I think many companies will see a very strong rebound. And I think one should be looking at that sector, and margins clearly are way below the 4-5 year averages, and valuations have pulled up as well. Even in the home building products, whether it be tiles, plywood, you are seeing some companies available at a replacement cost as well. When you look at the chemicals part, I think the tailwinds have started to emerge. We track a index of 12 chemical, which gets imported into the country. And for the first time after many quarters in the December quarter, the index showed a decline in terms of volume, which means that the import intensity has started to come down by the Chinese, which has been a concern by most of the chemical players. And with all the FTAs and their deals being done, I think India will manufacture for the rest of the world. And Prashant, you take it for granted. If everything goes well, there's no devil in the finer details with US or with EU. Next 12 to 24 months, you will see a large amount of JVs being done by Indian companies with their founder counterparts. The sense we are getting on the ground is that a large number of companies, global companies, wants to come and set up their operations or the back end out here, or Indian companies manufacturing for them. I think this will become a reality in the next 12 to 24 months. I think today there's so much of noise, there's so much of doomsday that nobody wants to focus a little ahead in the curve. But I can only tell you that if the trade deal is okay, EU trade rate is okay, you will see a large number of JVs being set up in India. And India will be a big beneficiary of the manufacturing renaissance which is going on. So I may sound a little positive this time, but I'm just giving you a flavor at the ground, what is happening. And I feel confident that after a long time, things are coming back. Promoters are thinking scale. Companies are thinking about innovation. I went to one of the factories and the kind of AI automation they have put in, I can tell you no other manufacturing unit in India, at least I have seen of that kind. So companies are thinking aloud. And I think that's a very, very good news for all of us.
Okay, well, good to hear, Pankaj. And it's not some short-term kind of flip because of the India-US or anything. There's really, and it's good to hear some fundamental optimism and work which is happening in your travels and feedback and company visits, etc. Thank you very much. Useful chat as always. Thank you for joining us. We'll take a break. Sunil Kaul of Goldman Sachs is with us. On the other side, we get a slightly more top-down view on what foreigners made of the last two big events, which is, of course, the budget and the India-US deal and what's been done there. So coming up in just a bit. Welcome back. Sunil Kaul is with us. He's Global Emerging Markets Equity Strategist at Goldman Sachs. Sunil, great to have you with us here. Thanks for joining in. You know, you upgraded your view on the market a few months back. And when you upgraded it, you only had, you cited a bunch of factors, the sharp underperformance of India. The steepest underperformance in 30 years, I remember. You cited, the tax cuts and the credit cycle which has turned, right? Now, you have more factors which have come through which were not there when you upgraded. You've got the India-EU deal, US deal. You got a budget which, despite the STT hike, there's other stuff in it which is pragmatic and perhaps provides continuity. And yet, look at the market, Sunil. Just look at the reaction this week. I know it's very, very short term, but the thing is, it's not holding, right? Tuesday morning, we got a 1,200 point gap on the Nifty. We closed 600 points higher. I'm not nitpicking here this day, that day. But broadly, my point is, I'm just using that as an example to say that interest levels perhaps still very much on the back foot in that sense.
No, look, Prashant, to be fair, obviously we are seeing a pullback in the global markets, right? I think some of the other markets in the region that went up much higher or have done much better, not just year to date, but last year, are actually seeing quite a bit of pullback this week, right? Obviously, not just the momentum unwind in US and the tech sort of rout in the US, but also I think markets like Korea, Taiwan, some of the other markets in the region are actually down quite a bit. So it's a weak tape, and India relatively is holding up pretty well. Obviously, there was a negative reaction on Sunday on the back of the budget, specifically around STT. But the Monday, I think market was reasonably up. You had a couple of down days on Monday, Tuesday in the global markets, but the market kind of pulled up. So I would say I think it's a weak tape, which is why it feels like the market isn't doing it as well. But overall, I think India is starting to outperform relative to many of the other markets in the region. And I would say, I think on our side, we have in fact seen a noticeable pickup in client interest, client queries over the last sort of few days. Our sort of flows on the desk have also turned more positive. And so maybe it doesn't show up as much in the headline index, but I would say I think interest levels on India in the last week or so have clearly picked up. Again, maybe if you step back, you mentioned some of the catalysts we had when we upgraded the market a couple of months back. But really, there were three main drags to the Indian equity market in terms of the relative underperformance, right? There was the earnings down cycle, which we have been in the last 15 months or so. There was the very steep tariffs with the US, and then there was the anti-AI trade in terms of India being used as a funding for some of the AI pockets in the rest of the emerging market. And I would say, I think two, if not three of those factors have clearly reversed, right? I think earnings, we have clearly seen a bottoming out of the revisions there. Things have started to see some upgrades. numbers are coming in pretty much in line with our expectations. So the demand is improving. The top lines are actually at 3-year highs from the current reporting season. So we are kind of everything we are hearing on the micro side in terms of earnings is pretty much in line there. And then obviously with the trade deal, you have a major overhang which is removed. So 2 out of those 3 factors are already reversed in India's case. Yeah, I mean, there is the AI trade, but you can also argue that given the steep rallies we have seen there is some signs of weakness there right now. And maybe people are realizing that it makes sense to diversify a little bit away from AI trade to some of the other domestic demand pockets, which has been our view coming into the year for emerging markets. And so I would say the setup for India is actually looking pretty reasonably positive here.
Sunil, zooming out, is there a risk of a deeper correction in emerging markets? We're seeing some signs today. Kospi closed down nearly 4%. Hang Seng has lost 3.5% so far this week. And you referred to a weak tape across Asia this morning. As an EM strategist, what is the call on emerging markets? And is there a risk of a deeper correction considering the valuations and the way these indices had run up?
I mean, you look, there certainly is to some extent, right? I think the risk appetite levels have been running pretty high, not just sort of for emerging markets overall, but our global risk appetite indicator, basically a couple of weeks back, hit levels, which is a cross-asset indicator, hit levels which it has only seen 5 or 6 times in the last 35 years, 2007 being one of the periods. Doesn't mean that we imminently have a correction or a deeper correction in the market. In fact, on that indicator, over the next 3 to 6 months, markets are still sort of fine, and then things start to mean revert a little bit. So my point is that there was a pretty strong levels of risk appetite in the market, and valuations had reflated. And so in that sense, some of this correction we are seeing is healthy. The only sort of point I would make is that, look, the periods wherein the risk appetite can still run a little bit higher is when there is a generally positive global macro backdrop, and that's where we are right now still in. So we still have a decent growth backdrop in US. We still have China growth improving. We are seeing a recovery in India. So the overall growth is holding up. We are seeing rate cuts in many pockets of the region. Inflation so far has not been a problem. And so that environment where growth is fine, rates are generally kind of trending lower, or at least not tightening, that's generally a pro-risk environment and generally positive for risk assets. And so I wouldn't think that it's a sharper correction we are seeing. You're right, I think multiples did expand globally, but even there, I would say that if you look at emerging market pack as a whole, we are trading at 13.5 times for earnings growth, which is close to 20% for the aggregate EM pack. Whereas Japan, Europe, they are trading at much higher valuations, 16 to 17 times for much lower growth. Obviously, US is at 22 times or so. So yes, valuations are high, but I would say some of the developed markets are at even higher valuations than emerging markets. So on a relative basis, as a house, we still have a preference for EM outperformance over DM. And I would say you might see a bit of pullback, but we are not expecting a deeper correction in the markets.
Like a what? Like a 5-7% kind of a pullback possible?
Yeah, that's possible. I think, yeah. We had a 30% rally in emerging markets last year. Obviously, we are 9% up for the year as well. So you could see a sort of 5% pullback or a little more.
This is for MSCI EM, not US. This is not US led in that sense.
This is for MSCI EM, but again, I think what we are seeing in this week is that pockets that have run up too much. That's where people are lightening up their exposure. I mean, even year to date, if you look at some of these moves, Prashant, I mean, we had pretty steep rallies, right? And some of those, that was obviously commodity led, copper proxies, Peru up 40%, Chile up 20%, Brazil up 20%, even Korea is up 30%, just year to date, which is a month of moves. So we have seen steep rallies, both on the back of AI continuing to press higher, and commodity rallies. And so there is a bit of sort of multiple sort of correction that could happen in some of these pockets. But again, bringing it back to India, it's a market, as we just discussed, the sentiment was pretty bearish. We hadn't seen as much built up in length in India over the last 12, 15 months. If anything, as we know, foreign flows were negative. And so I wouldn't think India has a large pullback on the back of this correction.
Yeah. So it'll be down 2 when MSCI EM is down 5. So relative outperformance in that sense, right? I mean, it's not going to go in the other direction, Sunil. Rarely does, right?
Yeah, that's true. But look, I think it's tough to, as you said,
Yeah, of course. But
buying on a weekly
all of this, I
basis.
mean, this 5% also may not happen. I mean, and also the point is, things rarely settle exactly at the equilibrium, right? I mean, markets overdo things and then, but yeah, that framework is constructive.
Zoom out, I would emphasize, if you zoom out, we are still expecting about sort of 15% upside for Nifty or MSCI India as a whole for the full year. That's pretty much what our earnings growth expectations are. So even without sort of tweaking with the multiples too much, if and we are comfortable with those numbers, if we think the underlying earnings to come through this year, I think the market should be higher by mid-teens over the next 12 months. In the near term, yes, with the global risk off, you could fall a little bit, but I think that would be a buy on dips in case of India.
Yeah. I had more questions, but Sunil, come back soon again, because these are very, very interesting times, hectic times, and so much happening. Thank you very much for joining us for now. Appreciate it, and really thank you for your time here. So yeah, I mean, looking a little wobbly as the global trend, that is, as we've also been pointing out, and Sunil Caller, Goldman Sachs, saying that perhaps after a furious move in emerging markets, is just red hot. So it could let off some steam, and MSCI EM, he says, could see about a 5% kind of a pullback. Nimesh is here with D Street Chatter with what he's picking up from dealing rooms. Nimesh, what do you have?
Hi, Prashant. Down day, but again, it doesn't look like it's a very large selling or a big selling pressure from the large institutions. We actually recovered from the intraday lows as well. But from a flow perspective, I think it's a positive day of trade, and within that, my sense is that even from the domestic, but the FIs have turned positive. Even within the domestic mutual funds, the sense I'm getting is that there is a bit of churn happening from large caps to small and mid caps. So that's clearly the theme of late, and that seems to be the day today as well. Even today, the broader market, the breadth is quite positive. The mid cap index is relatively outperforming. So in that sense, this outperformance in the broader market names, especially the small cap names, is backed by some bit of institutional flows as well, both domestic as well as some bit of HNIs and retail activity picking up in some of those small cap names. So barring commodities, which is under pressure on the back of global cues, I guess broadly the flow seems to be positive, and there is a bit of momentum back in the broader markets, which I've been saying for the last couple of days.
Nimesh, what about stocks? What bars have you picked up?
So the first stock on my list, Rima, is JSPL. That's been buzzing in trade today among the metal names, and that's because there is a bit of buying interest back, and I understand one of the leading domestic mutual fund has been an active buyer, so that explains that JSPL is relatively outperforming in today's market. The second stock is Crompton Consumers. Now, we haven't spoken about this name for a long time now. Again, institutional investors have lost some bit of interest in this particular name because of the underperformance, but looks like ahead of the earnings, there seems to be a bit of momentum and a bit of institutional flows back in Crompton Consumer as well. The third name is Ion Exchange. Again, as I said, some bit of institutional buying seems to be flowing back into the small and mid cap names. Ion Exchange stands out because I understand one of the leading AIF has been accumulating at current levels into Ion Exchange. And the last is Radico Khaitan. We've seen a bit of a correction in Radico Khaitan of late, but at these levels, some bit of consolidation happening. But also there is a buzz that maybe you'll hear some corporate development in Radico Khaitan very soon. The buzz is that maybe they'll hire somebody very senior at the top level. So that's something to do with the top rejig is the buzz as far as Radico Khaitan is concerned.
Okay. So that is Radico at this point in time. The others are also interesting. This JSPL, Crompton Consumer. Ion Exchange, of course, had a very large rally, and then, of course, a decent-sized correction as well. And then there is Radico, perhaps. There's a corporate development as well. Nimesh, you want to come in?
No, I just wanted to check with you, Prashant. What happened to PB Fintech? It's up 10%. Board meeting got cancelled. Acquisition seems to be off now. I don't know. I haven't heard yet or anybody explaining what happened. But anything that,
Yeah, no, it is. If you remember, Nimesh, when we put that story out, right? And I think you had sort of pointed Yash in the right direction with that lead that there perhaps is the plans to do an acquisition afoot. And we put that out. The company, of course, put that notice up for a board meet, for a fundraise, for a potential acquisition. Generally, the feedback was quite negative, right? And the next day, Nimesh, that is yesterday, we put out information that the fundraise size could be anything upwards of 3,000 crores, could be between 3 to 4,000, 5,000 crores, but north of 3,000 crores for a decently large-sized acquisition in UK or Europe. I mean, it was generally the feedback was quite negative. I mean, if you read Suresh Ganpati, Nimesh of Macquarie, I mean, he put it out pretty bluntly, you know, he's not the one to mince words, I think I have the thing with me here, but you know, not very appreciative, saying India market is large enough, so why do you need to go outside? So yeah, it's just pushback, I think, Nimesh, across the board. And Yash has basically now put out just a follow-up saying that it's been put into abeyance. So wider consultation, etc. I think it's in cold storage now, Nimesh.
But you know, Prashant, just to add to my feedback, I spoke to a couple of guys and the feedback is that yes, today there is a bit of a recovery, but I guess today's recovery is more to do with the short covering.
Correct.
But this will not go well. You know, if there is some bit of pressure from institutional investors and you back out a large plan, back out a large acquisition, it won't generally go down well from a long-term investor perspective. So again, a bit of feedback that I picked up from a couple of investors whom I spoke to.
Yeah. No, that's useful. It's one of those things, Nimesh, right? You can't, you do this, I mean, there's no way you can do something. You know, you move ahead, that's wrong, but if you cancel, that's also, you're in a bit of a quandary. But I think I'll tell you this, Nimesh, right? Unlike other companies, and we've seen this with companies across the board, with many companies, they've announced something, there's been pushback and they've called off. But I think with PB, you know, the founder, CEO, you know, he's a ambitious guy, I think well respected, and he's done wonders for the company, right? From the word go. So, I mean, I think in this particular instance, it's not some shady company which tried to do something, which has a kind of dubious past and has tried to do something. There's pushback and they call it off. So I don't think this is one of those instances. Yeah. So we'll see. There are other issues with PB Fintech, which is distribution cost and insurance-related, you know, the commission costs, etc. Yeah. That is the reason why the stock corrected in the first place. And then, of course, I mean, this fundraising plans was the last 10%, which is getting reversed today. So yeah, I mean, that is the that's my sense of looking at it. But thank you very much, Nimesh. And that's the chatter. Keep an eye out on some of the stocks that Nimesh put up. We'll take a quick commercial break here. We'll come back and we'll get you some buy today, sell tomorrow ideas on the other side with our technical experts.
Welcome back. Last leg of the markets. Mitesh is back with us. Mitesh, any interesting ideas that catch your attention?
Yeah. So I think Torrent Power is closing at a fresh swing high. BTST here at the stop at 1404 for targets of 1440, and Prestige. That's another one which is trying to reverse. It gave a bounce back and then completed a pullback. But after today's low, it's bounced back nicely on the hourly chart. So BTST here with the stop at 1510 for targets of 1545.
Bandopadhyay is also joining in on the show. Sudeep, your thoughts on QSR? We've had multiple false starts. There hasn't been a durable recovery in QSR stocks. So every now and then you get these one-day spikes, which makes you believe that the worst may be behind. And it's an attractive opportunity. This time, once again, Devyani, Westlife, Sapphire, all higher in trade. What is your read?
I think this time it's a little different. With the consolidation which has happened in the industry, Devyani is definitely becoming stronger, and the opportunity for it to scale up and provide much better return for the shareholders is real. Also, in case of restaurant brands, the acquisition by a new set of investors who have some experience in this space definitely should augur well going forward. So I'll be watching this space very carefully, and there is genuinely a scope for incremental earnings to accrue to these brands and these companies. Obviously, the market is definitely supportive of these companies at this stage.
Okay, so sorry, you're saying this time it's different for QSR stocks on account of the consolidation seen in the industry. But which is the stock you're betting on? I missed that.
Devyani is something which I'm definitely betting on. I think it's been a very good transaction as far as Devyani is concerned, and I definitely like the stock. I've been liking it for some time, and I like it more now.
Any other mid-cap earnings which catch your attention this time? So on the way up, you've got even a JSW Cement, IKS, Page Industries numbers look pretty good, came out a while back. Have you been buying anything in the mid and small cap universe?
Well, I think some of these earnings you talked about definitely look good, but post the India-US deal announcement, I have been focusing on chemical, specialty chemical, and agrochemical space. I believe that the good times for this industries should be here very soon. Look, most of these companies have significant exports to US, and the 50% tariff would have been a huge challenge. Now the tariff coming to 18% and China plus one remaining a valid argument. I think time has come for these companies to provide better returns. They were absolutely bombed out sector and companies. Performance also had been terrible, but things have started improving and green shoots are clearly visible. So an Aarti Industries does look good. UPL does look good after quite some time. And many other companies in this space do look good from a 1 year plus kind of a perspective.
Yeah. Thanks very much for that. Just coming back to you in just a bit, Sudeep. Take a quick commercial break here. We're going to come back with more. 9 minutes to go for market closing. It's not looking any better. About 0.5, 0.6% lower on the Nifty and the sensex respectively. Okay, welcome back. 4 minutes to go for close. Sudeep is with us. Sudeep, the IT damage we've seen recently on top of the underperformance, anything looking interesting now?
Well, I'll be definitely cautious, Prashant. I think the AI challenge, which the Indian IT companies unfortunately face, is real. A lot of kind of restructuring, a lot of adjustments will be required for them to get back their mojo. And I've been maintaining this view for quite some time, and their margins will be under pressure, definitely, with AI bringing down margins. So I'll be careful. I will focus on the niche IT companies, which are catering to specific segments like travel and tourism, or a transition which is happening in the automobile industry from ICE to EV. So Tata Technologies, Persistent Technologies, Coforge, RateGain Technologies. These are the companies which I would rather focus on with a specific objective of an industry which is growing by leaps and bounds, and they are the service providers to this industry. But the general IT service providers will have a challenge, and they need to adjust their models. I have confidence in our leading IT companies. I'm sure they will get back their mojo very soon, but I will wait and watch.
Any stocks?
Yeah, the stocks I was mentioning, Rima, is RateGain Technologies, Coforge, Persistent Technologies, Tata Technologies, with a very, very specific focus on a sector and catering to specific clients whose businesses itself are growing by leaps and bounds.
Kotak came out with a note. They call it plenty of panic over a little flutter. And they're saying that the downside risks stem from unknown future breakthroughs and not current proven disruption. So they believe the sell-off was a bit overdone. The market reaction has been disproportionate to the actual near-term impact basis, even what's come out from Anthropic's Claude. But the index per se is more on the flattish side. Sudeep, HAL, that's one stock. We'll be chatting with the management very soon. What is your own view on it?
Look, I've always been very cautious on this stock. There is no problem in their order book. So yes, what was announced yesterday, they have not been shortlisted, was a disappointment, and the stock corrected. But I don't think order book is a challenge. Execution has been a challenge for quite some time. And I'm pretty confident that if they can execute well on their orders, I think the company will provide handsome returns to the shareholders. Now, the question is, are they there to really deliver performance? That's what we'll have to watch. As far as the new orders are concerned, an L&T consortium or a Tata Technologies consortium or a Bharat Forge consortium getting probably is good, and probably even good from a Hindustan Aeronautics point of view also, because too much of order getting accumulated at their end and they not being able to manage would have, created problems for the company. So I'm actually, in a way, positive on the company post yesterday's news flow.
Okay. Sudeep, thank you very much for joining us. I think we're about a minute away from market closing. Thank you for being with us here as always, and speak with you soon again. By the way, just to wrap out things here and where we finally ended at, it is losses and Nifty down, the Nifty Bank under pressure, small cap index down 1, mid cap index slightly sideways as well. Defense saw some losses and HAL management coming up in a bit. Small cap index was down, as I said. The capital market space was down as well. PSU banks, perhaps the only large sectoral index which was up in the green in terms of what was up. Hindalco, Eternal, Bharti, BEL are the top Nifty losers, and Trent and Max Health and Tata Steel are the top Nifty gainers right now. Lots of action in terms of single stocks. QSR is a theme. Policy Bazaar, there was that story, and so on and so forth. So that is the market close which is coming through, and it's slightly disappointing because we didn't have follow through. I mean, the follow through fizzled out on day 1, day 2 was weak, and day 3 actually we end in terms of with losses today. It's a wrap and closing, but don't go anywhere. The HAL management comes up on the other side in just a bit.